Tom and I are getting,
What's that?
Tom and I are having issues over here.
This is Coventry.
I'm sure we can fit you in here, Lloyd, if you want to.
It's getting a little isolated.
Good morning. We have begun. Welcome to the 8th of August Finance Committee meeting. Today we'll be dealing predominantly with the preliminary finance and non-financial results for the year ending 30 June 2024. Firstly, we will go straight, and so I'd just like to remind that this is a summary of the position, our financial position to date, and that if we just as councillors reflect on the money that we have spent, while there is some very good grant money and support from both our port company and government agencies that we deal with, a big chunk of this money is our ratepayers' money. And we should just reflect that we are in fact spending their hard-earned money, and we need to ensure that A, it's accounted for correctly and that we're making prudent judgments to ensure we're spending that correctly. So just ask that you reflect on that as we go through these quite promising figures. So firstly, if I call for any apologies. We have an apology for lateness from Councillor Laws and Councillor Robertson. Ask if someone move those. Councillor McCall, second by Councillor Wilson. All those in favour? Aye. With no changes to the agenda. Just remind councillors that if they have any conflicts of interest to take the appropriate action as they see fit. So very good. We have a set of minutes there. I doubt you've all read and checked those out. So if someone moved that they be a true and correct record, I'll move to Councillor Metham, Councillor Noon seconded. Those in favour?
Aye.
There are no open actions from the resolutions of the committee to be reviewed.
Sorry, Mr. Chairman.
So,
Just to be clear,
Councillor Noon?
the motion regarding the minutes includes both sets of minutes. Just to be clear, so
Yes, sorry, yes.
highly,
Yeah, which is the 9th of May and the 29th and 30th of May to be true and correct.
thank you.
Thank you. My apologies for not making that clear. We move now to matters for consideration, which is 7.1. And I'm going to hand very quickly to Mr. Donnelly, but it is a preliminary financial and non-financial results for the full year. There is an encouraging surplus of 2.286 million. There's a very encouraging operating services for the stuff that ORC does of 941,000, which is exceptionally good. And the results are, of course, subject to the revaluations of our investment properties and our Port Otago shareholding, which will be done, plus the final audit by our auditors. But registering a surplus, Heidi, for our auditor, will be exceptionally happy that we've done that. So should we be, and we should congratulate our staff for that. And of course, we have our activity performance report. And again, that's reflecting no surprises from our last quarterly report. So Mr. Donnelly, online, I hand to you.
Yeah. Hi everyone. Hopefully you can hear me. Somebody gives me a thumbs up. Yep, we're all right. Sarah is just running a little bit late. She might sort of appear fairly shortly. And Mike, who obviously did the SSP measures and targets piece of the report, is he's on leave. So I'll kick off and just cover it. You've covered a fair bit of the intro that I would give. Is that the key thing is that this is not the final result, because there's still the revaluation of the port shares, revaluation of our investment property, and then any other final things, that adjustments that we might do. But from an operating point of view, so down to the operating surplus, the numbers should stay pretty much as they are. unless we find a few things that we just have to tweak. As you noted, we do have an operating surplus. It's better than budget, and it's slightly ahead of where we were forecasting as well. Within there, hang on a minute, there is a couple of reasonably big items that that happened or didn't happen, but they've offset each other. We haven't completed the paperwork and the sale of Birch Kitchener yet, so we haven't recorded the other income on that transaction. But offsetting that, we did receive an extra almost 3.4 million in Waka Kotahi grant funding that has gone through the revenue. So those two have largely offset each other compared to where we were at, in the previous quarter and what we were forecasting. There was still some other activity areas where the final numbers that we've landed on have come out slightly different than what we were forecasting, mainly with a little bit of underspend in some of the activities, particularly in the environmental implementation space, and that's where that the overall forecast then has come in slightly, or the overall result has come in slightly ahead of where we were forecasting. And then what I'll do is Sarah can sort of take you through the individual reports, and then when we get to the statement of service performance, I can sort of cover that. But we have got it noted in the section in the paper there. Some of the SSP indicators, we have had more move to yellow than we did have at the previous quarter. That's quite sort of normal at this time of the year. A lot of them are largely around the fact that that work has been done but hasn't quite got over the line. So the yellow for this final one means that, or indicates that we view those as partially achieved, not fully achieved. And there'll still be some debate to go with the auditors whether they see them as yellow or red. But a lot of them are, the work has been done. Some of them just they haven't been able to be marked green because the report hasn't gone to you at a council meeting yet. Some of those reports are actually going in this committee round. So that's sort of the summary of where we've landed. The other thing would be just if you have a look on the statement of comprehensive revenue and expense, the big thing that stands out is while the overall surplus is roughly where we'd budgeted, slightly ahead, there is actually a variance to our overall expenditure, and which was ahead, which was up on the budgeted amount, largely because of transport. Public transport is always the area that is difficult to forecast or budget the expenditure, particularly when service adjustments are done through the year. So there's an increase in public transport spending, and then that's also reflected in an increase in public transport grant revenue, as we received 50% of that increased spending from Waka Kotahi, and then of course there was the additional 3.4 million one-off as well. So unless you want, Sarah could go through the individual reports, or whether you just wanted to go through each one, it's really up to you, Chair. Whether you wanted to go through each of those financial reports, Sarah could probably give you a summary and you could ask questions. And then, like I said, I'll cover the levels of service report at the end.
Excellent. Yes, we'll hand to Sarah, and Sarah, if you could summarise in your normal good fashion. Thank you.
Sure. Apologies for being a little bit late. My war with the photocopier I did not win, which is why I have my laptop. It's not it is me. It does not like me. So apologies for that. After 10 minutes, 15 minutes, I kind of gave up. So yeah, sorry for that. So if I run through the statement of comprehensive revenue and expenses, so I have described in the report some of the large variances. So there is a variance of 9.9 million from what we originally from what we originally budgeted. So we've received more subsidies and grant revenue than what we originally budgeted, which was the 20 million. We've received at 30 million, it's just about $10 million higher. Most of that is in Dunedin public transport grants. However, I just want to state that it's offsetting expenditure. So overall, when you look at the actual activity for transport, it is clearly offsetting additional expenditure that we've had. So that is money that we've received from Waka Kotahi, NZTA, but obviously it's just that when we do our budget, we don't know what those funding and expenditure levels can be. And obviously, you know, it's been higher, but we've also received that revenue on the other side. So that is explaining most of, because it's $6 million for Dunedin and $1 million for Wakatipu. So of the 9 million, 7 million is just purely relating to those two bus networks. There's also been an increase in total mobility services. Oh, sorry.
Oh, yeah, just a question from Councillor Methven.
Yeah, just perhaps if we go through it, if you could accept questions, that'd be quite good.
Sure.
Just on public transport, the big increase for our rates this year was to account for the deficit of transport carrying from previous years. So this 7 million extra that you've got for transport, which you're reporting, is that in some way to go to, is it accounted for in that deficit that we're carrying forward? Because we've raised our rates significantly on the basis of transport. So this extra 7.7 million, can you explain where it came from? Why?
So it's not actually it's not a net profit. What goes into the reserves is the net of our revenue and expenses for the transport activities. So that is how we fund them out of the reserve. And that the transport reserves have gone into deficit because for multiple years we have not rated and received enough funding for the operating cost of our transport networks. Now, what that is saying in relation to the revenue is that this year we have received more revenue from NZTA, but what I'm telling you is if you go down and look at the detailed activity financial summary, and there's one there under the transport activity, you will see that in actual fact, the surplus isn't the 6 million and the 7 million that I'm speaking about. That is just increased revenue.
So that
Sure.
page,
So
page what?
it's
34.
yeah, thank you. I was going to say 13 in my report, but yeah.
Page 34.
So you will see that we're talking about in the first column's the revenue. So you can see that for PT.
Sorry. Okay, so transport we're seeing 42,817. Is that what we're seeing?
Yes.
And,
so
and then you've got a budget of 34,624.
correct. So
And
that's
you've
the
got a
revenue.
variance, a positive variance of 8,193.
Correct.
Right.
But then if you come into the next column, you'll see that our cost.
Which one? The expenditure? Yeah.
Yep, the expenditure column. You'll see that our cost was 6.6 million higher.
Yeah.
So most of that funding revenue, the additional funding revenue that we've received, was actually to fund increased expenditure in transport.
Okay. So we were anticipating a loss of 1.4 million. Is that right for transport?
Yeah.
And instead we've made a surplus of 21,000.
Yes, which is in the scheme of transport costs very good at nearly breaking even, but it's not much of a surplus.
So, but I mean, compared to our budget, I mean, when we were forecasting our rates increases, we were looking at our budgeted position, I imagine.
Correct. Yeah.
So we've got a variance to budget of 1.5 million there.
So that is because.
Sam, just pop your mic on.
Oh, sorry. Yeah.
Sorry. So in response to that, we try to smooth our rates. So we could have gone out and funded the whole lot to be zero, but that would have been a really large swing in those rates. So we do budget to make deficits in some years, and then we need to claw those back in other years to obviously bring those reserves out of deficit. So for this year, operating wise, transport has fallen with a surplus of 21,000, which if I'm honest is really good to getting to zero, which is what we kind of want, but we do budget for some years to be in deficit. And the additional rate that has been passed in the rates resolution, that is to pay off previous year's deficits, which are quite large.
So can you just explain what happens with this? Okay, so there's a surplus of 21k.
Correct.
That goes into that carry forward.
It goes into, so there's going to be two reserves. One is the historical losses, which are being funded. I think it's over 5 years was my understanding that we were going to fund that over 5 years. Originally, we had proposed 3 or 5. So that was over 5 years. And then there is the transport rate, which is actually to fund the operations of transport. So we rate every year for that. However, the majority of the funding for transport comes from Waka Kotahi and from the fares. The amount that is targeted rate funded is the smaller proportion.
So yesterday we got reports back that at public and transport meeting that we were exceeding our expectations in terms of patronage on the buses, and I imagine revenue as well.
I haven't seen the type.
I can answer that one. What you saw yesterday was a comparison of fare revenue against last year. So it was a year-on-year comparative. What you're seeing here is a comparison of revenue to budget. So yes, as you saw yesterday, the fare revenue has increased. There is a slight difference in the way we record the fare revenue and grants in the financial numbers that you see come through here, in that yesterday's report, where it talks about fare revenue, that's recorded out of the ticketing system, and it actually records some of the grant revenue that is topping up things like Community Connect is still recorded as fare revenue in that reporting yesterday. But when it comes through here, what we see in here is that fare revenue is only the fare revenue that we take from the external customer. And if Waka Kotahi tops up some of that, as they did with Community Connect for a period this year, and they did a lot last year in the 2023 year, that is recorded as grants revenue in the financial statements. So both numbers are effectively the same across the whole PT revenue, but they're recorded in two different lines. But where you saw yesterday, for example, Dunedin in the PT committee was noted that fare revenue was up 20%, and that's absolutely correct. Our budget for fare revenue also went up 20% from the previous year's budget. So we're actually, I think what we've recorded here is we're actually a couple of 100,000 under budget for fare revenue in Dunedin. And the difference is there's still that other income, that the grant revenue for things like Community Connect that goes through grants. But underlying that, what you don't see when we compare the budget here is, in fact, the way that the numbers work. If we were to show you last year's fare revenue that comes through the statement of comprehensive revenue and expenses, it was actually for Dunedin, it was under 2 million, because the previous year had even more fare revenue topped up via Waka Kotahi for various reasons. So that's why you see a little bit of a difference. But underlying, when you look at total revenue, the PT revenue numbers are the same. They just they just interpreted it slightly differently. An answer to your other question, Tim, about I think what you were asking is, what's the impact of where we've landed with the actual result on the deficit that we've now said that we're going to repay over the 5 years. If you go to page 30, which is, it's the same number as you were probably looking at, but as you said, the transport surplus, the actual transport surplus has come out at 21,000, although some of that is in PT other, which doesn't actually count through to the two PT Dunedin and Wakatipu, which is where the deficits are. But effectively, it's about the surplus deficit is about neutral. We had budgeted for a deficit of 1.5 million, but that 21,000, if we hadn't have recorded that other income that Waka Kotahi gave us, the 3.4 million, we actually would have been underlying, 3.4 million in deficit. So we would have been worse off than what we'd actually budgeted in the when we were going into the LTP and where we thought we were. So we do have to do a final check of where all the reserve balances are going to come out. But indicatively, what that means is that our starting deficit that we were going to repay over the 5 years, and we've already started with the amount that we're going to rate this year, will actually be bigger than what we'd forecast it was going to be going into the LTP. So we're either going to have to, we're going to have a conversation about, once we know exactly what the number is do we increase the amount for the remaining 4 years so that we still recover that actual deficit amount over the 5-year period, or do we roll into a wash up in the 6th year? But once we've got a handle on what the final numbers come out, we'll have that discussion, which will be as part of the annual plan process. But we're definitely, indicatively, it means that we're sort of, we were budgeting for a deficit of sort of that 1.5, and we're 1.5 million better, but it might actually come out a little bit worse than that. So yes, we're going to have more deficit to recover over the 5 years than what we'd forecast in the LTP. But that was always going to be the case because we were reliant on getting these final numbers in for this year.
So just the additional money we got from Waka Kotahi, then that 3 million, whatever it is.
Yep.
What was that for then?
Well, that was just after we'd closed off the accounts last year, Waka Kotahi gave councils and us a one-off payment just to cover. All councils had the same as we had been running, deficits. And Waka Kotahi just allocated more funding as a one-off. It wasn't for any particular, funding line or bucket. So we've had that sitting there, and then we've taken it to revenue at the end of the year. We did forecast that would come off off our estimated deficit balances when we did that calculation for the LTP.
Yeah,
but obviously we've landed slightly worse with the underlying, it's was actually going to have a little bit more to fund.
So that money that we received, was that for the period ending the 30th of June? Was there any sort of carried forward into a different period, or was it all applicable to the finance year that we're talking about?
Well, no, it's all been booked in this financial year because we only received it in Q1 of this year. But it actually was a historic payment. It related to the previous year or years. It was.
So what I'm struggling with in your answer is how the deficit is worse than we thought, when we're actually going at the end of this year. We're going forward with a variance of 1.5 million better than what we thought. So how can the deficit be worse as the starting point for next year?
Because that one there where it looks like it's 1.5 better, the 1.5 better has been, if you like, improved by the 3.4 million extra that we got.
So you've got
to go back to look at it, excluding the Waka Kotahi one-off, because I already had that factored in to what we thought the starting balances to be repaid over the 5 years would be.
So that payment had been considered in our long-term plan forecasting.
It had. So it came early. That's
so
what we
already put that in the long-term plan in terms of our assumptions for those deficit repayments.
Yeah.
What it's done is make our result look a lot better, because while our revenue has improved, our expenses in the public transport, specifically due to driver wages, because we significantly increased those through that COVID period to address that driver issue, meant that we have booked a lot more expenditure than we had forecast. So the result has ended up effectively looking like and it is a good result for us, and we should be pleased with it because of the number of passengers that we're carrying. But it still has created pressure in terms of, because we had forecast a shortfall, we hadn't budgeted in year 3 of the last annual plan to balance our public transport costs, because it would have been a significant increase in rates because of those driver wages. We have, moving forward, budgeted to cover all of the expenditure in public transport to avoid getting into this deficit position again.
So that was an unexpected amount from what it was planned for, but you were expecting that Waka Kotahi was going to give us that extra money. So that's a yes. Is there anything in our plan going forward to allow for that again to happen with Waka Kotahi? Was that just a one-off grant that we got?
No, it's not. And with the pressure on the government's transport budgets, we shouldn't be expecting it. It was something that I think there was obviously some money left in some of the funds that had been set aside to assist with COVID pressures, would be my sense, and a payment was made to all public transport providers, councils, but we shouldn't be we shouldn't be, and we haven't accounted to receive a payment like that in the future. We've only accounted for the normal subsidies we receive as part of our operations that are approved through the land transport plan process.
Thank you, Mr. Chairman, for allowing me to persist with those questions.
Okay. Good questions.
Yeah, I understand the situation and thank you for the clarification. What I don't, I'm pretty minimalistic on the accounting side, is it would have seemed only right that that money went and repaid reserve deficits in one tranche, and then our operation budget to look like it really was. And that's what I don't get with this accounting system, because if that grant had been,
Yeah, that's what has happened. Although the way to get it into the reserves is that it has to flow through revenue. So when we receive the money, we have to put it into revenue, and then obviously it goes into reserves. So effectively, that's exactly what's happened, is that it's gone to reduce those reserve deficits.
Okay, and yeah, just because I'm a simple accountant and the stuff, I would have put 2 extra lines in and just shown that transaction, and then thank you.
Thank you, Sarah.
So if I go back up in my report, so the next variance that was quite.
So what page are we on, please?
Because I couldn't print it from Doc Assembler, sorry. I'm just going to start discussing, so if everyone's happy, if we move on from the subsidies and grant discussion to other income discussion on why other income has a variance, is that?
Page 29.
Page 20. Page 20.
So this is paragraph 9 of my report.
Paragraph
9, yeah. So our other income is below what we budgeted. So we've already discussed the reduction in our budgeted income because the sale of Birch Kitchener did not go ahead. So just to be clear, Birch Kitchener is sitting on our balance sheet as it's classed as property held for sale, which is a current asset, and it sits at its cost value. So that is why we cannot recognise the revenue that we expect to get when we sell it. So that will come into the next financial year because we're assuming to sell it. Yeah, hopefully we do sell that.
So we'll have a positive variance as soon as we start the financial year with that.
We will be reforecasting
It
that
hasn't
annual
been
plan.
budgeted. It hasn't been budgeted.
It was budgeted in this financial
Okay,
year,
so-
but the sale has not
So
taken
we'll
place
see a
yet.
positive variance coming through because of
Yes, that
So
will be coming through into the next financial year, correct.
just have to make sure that doesn't cloud our judgment and how well we're doing, sort of thing.
Yes, correct, yes. So yeah, because it will be showing as a variance next year. We can, if you wanted to, I could put it as a separate line in the other revenue expenses or something. Yeah, anyway, the other thing is in relation to our rates collection penalty interest. So I know that we've discussed this in the past. What we had budgeted was too light, if I'm honest. The penalty hasn't changed. The amount of people, I brought it to you in a paper in November, the amount of people being charged the penalty hasn't actually moved that much. We then also, this is the discussion on the fare revenue. So the next 2 bullet points. So fare revenue is classed as other income. So the fare revenue for Queenstown was above our budgeted revenue, and for Dunedin is below our was below our budgeted revenue. But I just want to point out that is as Nick said, it's the public paying. So NZTA also pay a proportion of some people's fees, Super Gold, the children, etc. So they go up into the subsidies and grant revenue. We then also had a little bit of a difference in our Lower Clusa flood protection scheme revenue. Now, my understanding is that's just timing of how that project has actually been running, and it's quite difficult to budget those large projects and where they will fall with contractors, etc. And then there is a small variance, well, there is a variance in consent processing revenue, but I just wanted to point out that there's also been a reduction in expenditure. So that is actually, we have done less than what we originally budgeted because we weren't required to do as much from the public. Is there any questions on that? No? Okay, the next paragraph, paragraph 10, we always have this little variance, which we will be fixing next year in the annual plan. So dividends for the managed fund actually go into the dividends line on our screen, but in the budget, they were put into investment income. So we always have that little bit of an offset variance. The dividends include an additional $1 million from Port Otago, and our dividends for the managed fund, I think, are on track with what we had budgeted. Yeah.
So just in terms of the dividend from Port, it was as expected. We received 10 million, is that right, from Port?
We received 1 million.
16.
So we forecast the full, and no, you go, you know.
Yeah. So I think I've just got to get the number up there. Yeah, we got 16 million instead of 15 million. It was just because what they've historically done is they've paid the dividend in 3 parts. They've always they've paid, if you like, 2 interims of basically, you know, sort of in this case they would have paid 7.5, and then they've always done a final payment after year end. But we obviously only record it when we receive it as cash. So we've always sort of, from a timing perspective, been receiving a portion, which is, as it's got bigger, has been about $1 million of like a year's dividend after the year is closed. So what they've decided to do is basically just pay an interim and a final, both of which are paid in the financial year. So we get the first one usually around might be January, February, and then we'll get the final in June. So what they did is they've changed to that. It's meant that in this year we've caught up that $1 million final. So this year effectively got $1 million extra. So it's recorded as the 16 instead of the 15, and then going forward for this financial year that we're in now, that steps up to 18 million in the LTP.
Mm-hmm. Thanks,
Nick.
Is everyone happy with all the revenue items if I go on to expenditure? Yeah. So the first thing for expenditure is the employee benefits expense. So I've put in the table for you of what our FTEs are for each of the quarters, as well as the prior year FTE budget. So what we budgeted to have, and then what we actually have for each of the 4 quarters. So we are running with staff that are below budget. However, you will see in my comments around other expenses that has resulted in us having higher other expenses to actually fund our activities. So we're just talking about one line of the statement of the screen.
I'll just make a note for the committee that this is one that will be important to keep an eye on in the financial year that's just started. The employment market's obviously changed, as we've seen in the media. And while we've carried lots of vacancies for the last 12 months, which has led to the result, you can see through Sarah's report, quarter 1, 2, 3, 4, we've slowly been filling up our allocation of FTEs, and we'll just have to manage that budget carefully because we are not anticipating to have the level of staff turnover that we've been having for the last 12 or 24 months. So I would just say to the committee that it's a line that would be worth keeping a close eye on for this year going forward.
Thanks, Richard.
So the other variance that we have in the expenses is around other expenses. So that was 7.4 million above budget. The majority of that is the public transport cost. So that is the cost of our operators actually running the bus service. So you would have seen, as I've already discussed, but we had the income on the other side, and this is the expenditure side that is offsetting that. So that's 5.3 million of the 7.4. We've also had an increase in our repairs and maintenance expense. So we had some damage done to the Lower Clutha flood protection and drainage scheme in the 2020 flood event. That is, it's been repaired and funded by NEMA. So we had increased repairs and maintenance than what we had originally budgeted, because it's difficult for us to know until they do those detailed inspections, which has been done, exactly on what needs to be repaired and replaced. But that is a bit of split funding between the scheme and mostly funded by NEMA. We then have had some increases in costs at council that has happened kind of everywhere. So insurance costs have gone up for us. It's nearly double what we had budgeted. So there's been a 232,000 increase on our budget of 280,000. We've also had a little bit of, it's a bit of a mixed bag. We've had a reduction in the maintaining the games funding. So we've reduced our expenditure there because our revenues decreased. So that's funding that comes through from central government, and obviously with the drop in some of those, the work done in some of those programs, we've also got the corresponding expenditure drop. So that was lower than what we expected when we made our budget. We've also had increased costs in IT around subscriptions and software licenses. Now, the majority, and I actually think probably all, I'm not sure, but very much the majority of all of our software is linked to inflation. They are all mostly overseas or programs, so it's overseas inflation, and that has caused quite a large increase in costs than what was originally budgeted. So that's the likes of all of what you're seeing in front of you, all your Microsoft products, etc. We also had there was a bit of a increase in of 171,000 invested assets. So I think I've discussed this before, but I might just go over it. So we do LiDAR aerial mapping for the Otago community. Now that is an asset that we use at council, and it is widely used in engineering and hazards. However, it is partly funded by LINZ, and we make that available to everybody in Otago. So that's on our website. Anybody can download and use that data. So therefore, it doesn't meet the definition of an asset, because we don't have control of that, and we're not getting a financial benefit from it, and we won't get a financial benefit from it in the future, because we give it away to people for free so that they can do their own assessments, etc., and research. So that is why it's classed as a vested asset. It isn't that we've just given it away for free. We have given it away for free on our website, but the idea is that it can be used by multiple scientific bodies for the benefit of Otago. And my last bullet point is just the increase in casual labour, which really relates back to the fact that we haven't been running with our budgeted FTEs.
Thank you, Sarah. And question from Councillor Noon.
Thanks, Mr. Chair. Just going back to the increased costs in subscriptions and software licenses, do we have longer term type subscription arrangements rather than annual? And why I ask the question is that from a budgeting perspective, if they are longer term, let's say 5 years or something, I imagine those agreements have a inflation adjusted clause that kicks in on an annual basis. So we do know to a certain degree what's coming, or do we not?
We do know to a certain degree what is coming. We have had more, so traditionally in the past, software programs that we've bought have been intangible assets. They are now virtually everything that you buy is what's called in the cloud. So it's software for a service. It is, and under the accounting treatment, that isn't classed as an asset. It's classed as expenditure. So that is why that line is increasing. It's not that we're actually buying more. It's just where it sits. So it used to sit down in intangible assets, and we would amortize that. We now have to recognize the expense straight away. So some of it is the licensing cost of that, which also includes like service elements. And so it's just a change in the way that they're funded. Yeah.
I think too, Andrew, the model for IT subscriptions is fairly set in the market. There's not a lot of room to negotiate your own licenses. So I'm sure that what Robert is doing within that team is just following the best practice models, and wherever we can, we would have visibility on what that inflation might be, but it would be driven by market inflation as well.
Thank you.
Further questions from that part? Sarah, if you could just give just a quick summary of the next two bits would be really good.
Sure. So the next part is the balance sheet. So these are, this compares our assets as at 30 June, our draft asset position as at 30 June against what it was prior year. And then we also have the budget. So if I just run through it, our cash and cash equivalents, we always have a bit of ups and downs. It's actually pretty much in line with what we had last year. 1.2 million cash difference actually isn't that much for council spending. We see if I sorry, I'm just going back up to my notes. There's been a small decrease in trade receivables. Now that has been as a result of, we changed our accounting system at the 1st of July. So we did a whole lot of interim billing in preparation for that. So we did more interim billing than what we've done in previous years in the April, May and even June period. And so it just meant that there was a decrease in trade receivables, which kind of includes accrued revenue because of the fact that we'd actually collected that. The other financial assets is our managed fund. So that has increased by 2 million compared to the prior year. I do have in the note in paragraph 14 a detail of what our movements in our property, plant and equipment are. So just around additions, disposals and depreciation. And the other key things, I suppose, on our balance sheet is just the related party loan with Port Otago. So the related party loan with Port Otago, we hold it as a non-current asset because it has a repayment term cancellation of 24 months. But the borrowings that match that below are held on their terms of what their LGFA borrowings are. So that is why they are current and non-current, because those loans obviously are fixed and then roll over with their terms.
Just another question.
Go.
So we see this time last year 125 million to Port Otago, and this year we're 114 million to Port Otago, so a decrease of 10 million, roughly 10.650. And then if we drop down to borrowings under current liabilities, we see an improved situation there as well. Are they related?
So Port has decreased their borrowings slightly. So their borrowings are obviously related to what capital that they require.
Yeah,
and it's
but the value of the borrowings is 114 million at the moment as a non-current asset. We're seeing we've lent them that.
Yeah, that's correct. Those two are related.
Yes,
Sorry,
they are
I'm actually looking at the balance statement of financial position, that report.
No, you are correct. Those two are related.
Okay. So they've repaid 10 million, basically.
Yes.
Basically, yes.
That's good, thanks.
So if I continue on, if everyone's happy with the balance sheet, just to my Treasury report. So this is similar to what you've seen in previous quarters. We don't have any term deposits at 30 June. That is quite common at 30 June that we don't have any term deposits. We rate and we'll be sending out our rating invoices in the first week of September. That's when we get the majority of our cash in for the year in relation to that rating revenue to obviously fund our programs during the year. There's a table on the portfolio performance, which is the managed fund. There's also a table about our SOPO, making sure that we're in line with our SIPO requirements, and then I do a bar graph of the managed fund, just showing the amount of each of the funding buckets that we have under the SIPO against the SIPO target.
That's good, Sarah. Mike, is there any other questions on the financial reports? We would like to have a look through the activity performance report. People comfortable? Comfortable. Thank you, Sarah. We'll now go to the activity performance report. And Nick, this is where you wanted to jump back in?
Yep, I can jump back in and cover that one. It's probably obviously you got the report and the attachments there, but the cover paper has sort of has a summary of the key things that have happened. So I'm just getting to that one. So that's like in the cover paper, that's starting at paragraph 22. So on page 23. So we've got 76 targets. 53 are achieved, or I should say achieved, not on track. And last quarter that was 66. 18 are partially achieved or yellow, and that was 7 last quarter. And there's 5 that are red, or not, which is not achieved. So there has been an increase in the red and yellow.
Sorry, just a question. Let's have a quick question on this. At the 30th of June, that's the end of our financial year, right? That's the end of everything. So you were just mentioning before that there would be some sort of discussion around whether we had milestones at risk or not achieved. Now, I don't think that at the 30th of June we can say that anything's at risk. It's either achieved or not achieved. And you were saying something about the auditors and what's their view on it?
Yeah, so the way that if you look at that paragraph 22, that's what we've said is that there's 18 that are partially achieved, and there's 5 that are not achieved. So for previous quarters, we used to call the partially achieved, which is the yellow. That was, as you go through Q1, 2, 3, we refer to that as at risk. Yeah. So we're sort of indicating that we think there might be a risk that we're not going to achieve it. When we get to the final quarter, where we're at now with year end, we refer to the red and yellow as either achieved, as either not achieved or partially achieved. So we've got 5 that are red, which is not achieved, and we've got the partially achieved. If you go through and look at those,
the debate around this, Nick, is they're not going to be achieved because the 30th of June has happened. Okay, so when we look at this graph, when we look at the bar graphs that show the green, the orange, and the red, we should really just be looking at green and red. And if we do that, then it actually tells us a different picture. It gives us a different picture of our performance as an organisation and achieving our milestones that we've set in our annual plan. I honestly don't think these things are at risk. They're not completed.
So you're right, they're not completed, but there is the oranges there as a partially achieved. So and a lot of these things, as you'll see in the notes, and as we've reported through the year, we have made significant progress on, but haven't met. And that we need to be upfront about that statement. We haven't met the target that was set, and we might end up a month or 2. And take the climate strategy as a good example. But the way that the Audit New Zealand process says that does allow for that partially achieved to show that there was progress made, but we didn't meet the original target. So we do use that. There is always discussions through the annual report process with Audit New Zealand around what falls into the partially achieved versus what is just a straight out did not achieve. And so we make an assessment at this stage, but flag that it's still to go through audit. Yeah. So we use the system that's there. Take your point, you could take a hard line, it's either achieved or not achieved, you're either red or green. But also the system's there also to be able to demonstrate where progress has been made.
So in terms of our result, we're showing a $2 million surplus. And when I have a look through the activity performance reports, I see positive variances all the way through that. In all the areas that we're reporting in this bar graph. It would indicate to me that we haven't incurred expenditure because we haven't achieved the programs or the milestones that we were actually setting ourselves. So in order to say that we've made a surplus of $2 million, if we say we've made a surplus of $2 million, it's good financial management. It actually isn't. We haven't achieved the targets that we established in our annual plan. I think that's the way we should be looking at these things. It's just accountability. This is just
I think there's a bit more to it than that. In some cases, we have incurred the expenditure associated with that particular target, but we still haven't achieved, because through the program that we've identified some further times, because we set these a year in advance, and we've got to put our hands up and be better at setting these and understanding if we're going to put a target in. We're very confident that our work program will meet that. But I don't think it's fair to say that in every case where we haven't achieved something, we haven't used the expenditure allocated to that piece of work. In some cases we have, and we've spent everything that was in the budget to deliver it, but for whatever reason, we've extended the time frame, or the goalposts have shifted, so we've needed to reassess. So I think that it's important to look at the two of them together. And if we're running big surpluses but not achieving our work program, we should be looking really closely at that. But we've got to be careful that we don't just assume that if it hasn't been achieved, it's because we haven't put the resources into doing it. And that's where the explanations to this table need to be very clear. So we are being transparent in terms of the reasons why a particular target hasn't been achieved.
Yeah, and that's fine. I mean, we need this tension. This council needs to be able to ask these questions and put this pressure on you guys, because looking at it without proper understanding, it looks as if we're not actually doing the work we say we're going to do, and we're not spending money on it either. That's how it looks.
Yes, it's the purpose. Yeah, agreed.
We are required by the accounting standards to describe to the ratepayers. So we need to actually put a description in our annual report explaining why we've got that as orange and why we've got that as red. So under each of those performance measures, there will be a paragraph that's explaining why we've put that as yellow and how close we potentially got to actually performing that. And we do try and put statistics in there.
Yeah, and Tim, the key to that will be us as councillors examining the rigour around that descriptor and ensuring that gives us the comfort that's exactly where that target is. It hasn't been completed, and that's the reason why. And as long as we're comfortable, I think we've got to make sure we're comfortable with those explanations at that time. Further questions? Councillor Forbes, at this way there.
Yeah.
Just further to that, so the question becomes, is there anything in here, I don't think there is, that where we don't understand, where we should have spent budget, but we haven't, that's not explained. Is there anything else on there? I don't think there really is. It sort of looks like just taking Tim's point that step further.
That's a difficult question you just asked.
I know it's a difficult question, but allocating budget to things and not spending it is a different scenario from what am I meaning?
Yeah, I think Richard sort of answered that. A lot of these things that are on here are things that the work has progressed and budget has been spent. It's just that, some of the things we haven't quite got the full program completed, but it hasn't necessarily resulted in a huge budget variance or a significant budget variance. And some of them are simply around the work has been done. Some of them are around reporting. That the work has been done. It's just the final closeout is a report to council, and that hadn't occurred before 30 June. That's actually quite a usual one, and something that we need to look at going forward, whether we can actually have that, work program will be completed and reported to council, immediately following year end. Then we could go, so long as we've got it scheduled for a meeting in July or early August, would be able to tick it, and audit would see that proof by the time we're doing the annual report. So it is difficult without going through these line by line and saying, this one here was the budget impact. We could do that, but it would just take a little bit more time than we've had to the point of preparing this report.
Yeah, Nick, I think that's the sort of wriggle we need in our final report to say, yeah, the new signs for our council table was budgeted for. We had $100 in there to do those. We haven't spent it, and that's or being we've spent it, but they just haven't been delivered or something. So we need that bit of rigor to see where the money has and hasn't been spent.
Can I just explain my line of questioning? I mean, I looked through the activity performance reports, regional leadership, environment, safety and resilience, transport. Looking through all those activity performance, all the variances are predominantly positive variances against budget, which means we haven't been spending as much or we've had more revenue. So, I mean, that's why I've opened this line of questioning around, we haven't achieved these milestones, but we're also showing that we haven't achieved them through having positive variances in our activity reporting. So that's where I come from.
Councillor Wilson.
I think in the previous life, reading these sort of reports of the council, there were some of this issue, and I agree, I hate the word being used surplus, because that, as the chair said in his introduction, is money we've taken off people generally, and haven't spent on the year that we've said we would spend it. So it's not a healthy way of predicting it in some ways, but using it as a carry forward, so that it looks like it's a cost or it's not a surplus, and having that as a work in progress fund rather than calling the surplus as if it's
Can't carry forward. It's just accounting.
that's the difference, is because
Just
the OPEX, I see what you mean.
That's right. So
Yeah.
we close it in 30 June, and then we have to fund it out of whatever we budgeted.
What I've got to say, we do reforecast, and I think that that's what you were discussing. So it's the reforecast at Q1 that would include potentially costs from the previous year that we are now doing in this year. So that would be what you would see in a reforecast, not the budget like that.
Yeah, and but it's just calling to surplus is just problematic. Understand.
The key part will be that explanation in the final report, so we know exactly where it is, and that will either generate questions or give us satisfaction. Thank you, Sarah. Thank you, Nick. Any further questions? Councillor Moonway in there, secondly, Councillor Mepham. Any discussion? And the mover and the seconder. Look, just thank you very much for the report. There's good work to be done still on it, and get to the auditor and get their tick of approval. So I'm sure you'll have some very good discussions with them. And I'm sure Heidi in her last, I think it's her last audit with us, Nick, she'll be highly pleased with the positive result, which I certainly am. So well done. Thank you very much. All those in favour? Against? Carried. Thank you, Sarah. Thank you, Nick, and your team for presenting that to us. We'll close now and prepare for our next meeting.